we always want to educate all of our members because the best thing to do is to manage money on your own and never have to pay anyone else to do it. So you got 100% of your own money working for you and not a fraction of it goes into someone else's pocket. So I'm always about total education. So, and I always emphasize that in all my classes too. Personal finance is one of the courses I teach here at the college and I'm very passionate about because in my opinion, they don't teach it enough in school. Middle school, high school, by the time you graduate and go into college and become adults, you're lacking in enough financial education. So it's kind of my mission to make sure that people learn and what I consider a life skill, it's a survival skill for living, paying your bills, investing, not being scammed with insurance, all these types of things. So all the topics I think are really helpful. And we'll start out, first of all, are there any topics that come to mind that we may want to suggest we talk about for next month? Usually take a couple minutes that you've always been interested in, whether we've actually gone through it or not. I love repeat topics. That means already have. Most of our members are beginners, so any suggestions to have?
I guess recently
we should actually, I'm probably going to touch on that with the what the market been doing in the topic. I always talk about the economic really fine.
I was wondering, like, because I know
Sure, it's volatile.
it's variable. So I wonder, the stock market does crash. Like, what can you do to prepare?
Great topic. Yeah, let me write that down. So basically, investing in your market.
Mm-hmm.
We're investing in a recession. We're in a bear market, and we're yeah, there are actually ways to do it. Matter of fact, when I was in our investing class last night, I was talking about in the summer when the markets were really significantly crashing this past summer. I always use a catchphrase when I teach my friends to trade. Just take what the market gives you. Don't fall in love with a particular strategy. So what I was doing was I was trading inverse ETFs, meaning ETFs that are perfectly inversely correlated with the market, meaning they have a beta of -1. I know that sounds kind of weird and technical. All it means is if the markets or certain sectors of the market move in one direction, there are ETFs that move exactly in the opposite direction. So like when the NASDAQ and the tech stocks were going down, when I was trading options in a particular ETF called SQQQ, it moves perfectly opposite direction. Like it goes up in value when the markets are going down. There's ones that do it for the S&P 500 that move in the opposite direction. So right now, for me, the market's kind of going sideways. So most of my trades are actually kind of neutral, meaning that if the market goes up or down, if I stay kind of like, have my trades kind of like in the middle, then I should win. I won 4 trades today with neutral trades. So there's ways you just kind of have to just be adaptable. But that being said, to answer your question, there are actually certain ways to invest for the long term when markets are down, because there are certain things that are resilient. Good example is when we had the COVID recession in 2020. What were some companies that were making money regardless of what was going on in the economy? And we'll see. Performance spices. People had toilet paper. Or toilet paper. Procter and Gamble. So a lot. There's ways to invest in businesses that are going to sell products and services that people still want to buy regardless of what the economy is doing. It's probably a good way to do it. Or companies that will still grow and provide necessary services, like stocks that I'm not going to be selling anytime soon, are probably Microsoft. I had a winning trade in Microsoft yesterday, and I waited until I got a solid price, went back into Microsoft trade. On top of that, I own a couple hundred shares of Microsoft that I been reinvesting back in for, so, uh, another one, Apple. I'm going to sell my Apple anytime soon. They're not going to get out of this anytime soon. And that, Microsoft and Apple, unlike say other tech stocks like Amazon and Netflix, which I still have that, but Microsoft and Apple, they pay dividends too. So if you invest in companies that will pay you cash while you wait for the stock to go up, it's another way to fight bear market recession. So just kind of a taste on to answer your question, but I actually could put a handout together for that for next month. That's a good topic. What the market's been doing lately. Tomorrow is going to be a big or potentially a catalyst. There's a lot of expectations around what the Federal Reserve is going to say about interest rates. Tomorrow's the day where they're going to decide whether or not to either raise interest rates 0.25%, 0.5%, or not at all. One thing that wasn't on the table was the not at all, because inflation is outrageously still high. It's like 6%. I mean, it went down from 6.5% to 6%. It barely moved down over the last 2 months, based on this month's latest CPI number, consumer price index number. So the only big tool right now that the Fed has to fight inflation is to raise interest rates, take cash out of the economy, or to entice businesses to invest less, spend less, raise prices less, which is why interest rates have been going up by the Federal Reserve. So just 2 weeks ago, it was thought that they were going to raise it 0.5% because inflation is barely moving down. So they have to be aggressive. However, banks started crashing. Now, that being said, and the news has a tendency to sensationalize news, 3 banks crashed, not the whole system. One of the banks, Silicon Valley Bank, a lot of their investments were in startups, a lot of green energy startups, or speculative types of businesses, rather than in more conservative investments like that, government bonds and things like that, that could have preserved their depositors' money. So it was really bank management's fault of not being smart with their depositors' money. Then we had Credit Suisse. Credit Suisse, very large global bank. They got in trouble, and really because, and I can see why, they, to protect their investment money, they invested a lot in bonds. Bonds, in theory, are supposed to be relatively safer versus, say, investing in stocks. However, as we learned in finance class, as we learned in investment classes, if interest rates go up, the value of bonds go down. They go in the opposite direction. So unfortunately, if a bank's investing a lot of their deposit cash in bonds and interest rates keep on going up, not just Federal Reserve, by the Federal Reserve, by the European Central Bank, by the Japanese Central Bank, when interest rates are going up all around the world to combat global inflation, all the bonds that all these banks own go down. So that preservation of capital, unfortunately, is kind of being hurt, and the value on paper to the market value of the bonds have been written down, and so they are under it's called undercapitalized, meaning that they are not having a sufficient amount of backup cash to back up the deposits of people and businesses are depositing in banks. So Credit Suisse, to the tune of billions of dollars, is undercapitalized. And the way our bank works, the way our U.S. bank system works, all the banks have to have a certain amount in reserve to be able to deal with people withdrawing money out of banks, to be able to make loans, things like that.
Yeah, didn't they change the reserve, like amounts during COVID?
Yeah, they actually, to reinvigorate the economy, yeah, they lowered reserve requirements. So to lend out more money to kind of get the economy flowing again, to incite businesses to invest. But
You think they'll ever raise it back to where it was?
I think they might use it as a tool, but I don't think that's going to be their primary tool they want to think about right now. I think the reason why they would pull back on lowering the reserve rate again is because of the potential of a recession. Yeah. So raising interest rates enough is increasing the chance of recession. So that's the really tough balance, and that I don't envy the Fed economists, because if they lower interest rates, they increase inflation. If they raise interest rates, exacerbate a recession. So they're probably going to rock the hard place. It's kind of tough. So again, I just think they got to bite the bullet, just keep on raising rates, just get inflation back down to as low as it can, and then maybe think about stopping raising interest rates. So that's basically kind of like from a macroeconomic level, that's kind of like what, if you are an investor or a trader, you kind of want to pay attention to, because that affects the markets, that affects investments. So what may happen is if they raise it 0.5%, markets are probably going to drop right there. Could be a good buying opportunity if nothing has fundamentally changed about certain stocks. If they raise 0.25% tomorrow, markets might be kind of flat, or maybe even go up, saying more like a sideways. Okay, we expected it. We're kind of priced in with that expectation that they're going to raise it 4% anyway, with inflation still needs to be battled. If they lower, or if they not lower, if the Federal Reserve says, in light of the banks crashing, like the third biggest crash ever and the 16th biggest crash ever, we're not going to raise interest rates for now to give the banks some time to recapitalize, then it might go up. Market might rejoice in the fact that, okay, they're all halting interest rates. But I think what could happen is that in the morning, the markets will rejoice saying, oh, interest rates are not going to go up this quarter. By the afternoon, they're going to say, yeah, but inflation's still bad. And then it's going off again, which happens a lot, more often than you think. So again, keep it in mind. I'm going to skip the NFT handout till last. One of the nighttime members requested, what is private equity? And I put together an interesting handout about private equity, and I'm going to put that on the screen here. Now, I may never invest in private equity in my lifetime, but hopefully maybe when you guys may get to a level of net worth that you might be interested in investing in private equity. So basically what these are basically pretty good sized financial institutions with private partners. And what they do is they will invest, they will buy up companies, manage them or help them out, bring them out of trouble, and then resell them again for a profit. And it's generally not a short-term process. It could be anywhere from 5 to 10 before they finally turn the company around and sell for a profit. And there's different ways or types of private equity investments they would do. And I actually put some bullet points in there. So again, by the time they flip a company around, usually lasts about 7 to 10 years. And then once they make the profits, then they will redistribute the profits from reselling the now profitable company, and they'll redistribute back to the shareholders that pool their money together along with the private equity investors. So 2021 was the last stat I was able to find. Average holding period for a private equity company is about 5 years. So they usually can try to turn them around in about 5 years. Unlike venture capitalists or angel investors like you see on Shark Tank, private equity companies actually invest in companies that have been around for a while, usually mature. Either they need help, maybe they need help in organizing their sales pipeline or research and development, or even something as simple as they don't have enough cash or credit to expand or scale up the business. So I found some examples of some noted private equity firms if you're interested in researching it. And what's cool is that these actually can be investable in the form of stocks, stock shares in the private equity firm. So the Blackstone Group's the most well-known, KKR and Company, so symbol KKR, the Carlyle Group, CG, and Apollo Global Management, APO. So those are ones, if you're interested in private equity, take a look. But again, do your due diligence, take a look at the stock chart, see what the stock's been trading, take a look at their record of success in turning around businesses, and also take a look at their trend of revenues and profits. I didn't look at any of the financials. I just wanted to share with you some examples of companies you might be interested in for private equities. So what types of them are there? basically broke it down into 5 different kinds. So there's distressed companies that need more financing, so the private equity firm will come in and try to rescue them until they become profitable again. Growth equity, so these are private equity firms that will invest in companies that have the potential to grow and expand. So the private equity firm comes in and provides consultation, help them grow and expand. So they're not startups, they're a little more mature, but they have the potential to get even bigger. Sector specialists firms, so some of these types of private equity firms will focus on a certain sector of the economy. So there's 11 different sectors of the economy. Some of them will focus on just tech or real estate or healthcare or consumer goods, depending on what type of company they want to turn around. Secondary buyouts. So this is actually deals among private equity firms. So a private equity firm invests in a business, they're ready to sell for a profit, and then another private equity firm wants to buy it. So they'll sell it to another private equity firm. That's a secondary buyout. And then carve outs, it's kind of like when a company spins off a business unit. In this particular case, a private equity firm is going to buy a business unit from a company that wants to sell it or carve out a particular business unit from a company. So instead of the company spinning it off into its own company and sell shares for it, they'll just sell it to a private equity firm to do that. What makes private equity firms attractive versus some public companies is that they are exempt from SEC regulation. They still have to provide quarterly reports to investors under the Advisors Act of 1940. Just last year, the SEC requires now that private equity managers have to tell investors or disclose to investors what fees they're charging, what expenses they're charging, and make sure that they have to do annual audits to make sure that the private investors into these private equity firms know what they're getting into. So, and they're just not, hustling them out of their high net worth individuals out of their money. So that's a primer on private equity. Probably my favorite topic to talk about today is dollar cost averaging, which is what I do now. And for beginning investors, it's a great practice to have. So, and as I mentioned in a lot of my finance classes, basically the beauty of dollar cost averaging as a strategy for investing, it takes luck and timing out of the equation. So you don't have to wait and time the market, whether it's up and down. You don't have to try to, hopefully you'll be lucky to figure out the best price to buy and sell a stock. All dollar cost averaging is that you have to be disciplined. So every single period, and you pick whether it's every paycheck, every beginning of the month, every bi-weekly, whenever, on regular intervals, you put the same dollar amount and you use the same timing in investing in a stock. And as long as nothing has fundamentally changed about why you wanted to buy that stock in the first place, then what it does is over time, the average price you paid for that stock is going to be lower than what the market value is. It also prevents you from emotionally trying to buy into the hype when the stock price is too high. And it allows you to buy more shares of a good company when the price is down. So how does it work? You put the same dollar amount every period, whether it's monthly, bi-weekly, quarterly, whenever, regardless of what the stock price is. So again, it takes emotion out, takes timing out. So as long as the same amount over time, it doesn't matter, because since you're putting the same dollar amount every interval, you're buying more shares when the price happens to be down that month, and then you're buying less shares when the price is too expensive. So it actually prevents you from buying too high at the top, and that's actually the beauty of it. So the average cost over time is going to be lower than the average price. It also encourages discipline and regularity. And you can actually, if you use this practice in a retirement account, so whether it's IRA, 401k at work, 403B award, you got a government or nonprofit program, you can have it automatically deducted, so you don't even have to think about it. So I've got an automatic amount coming out of my paycheck going right into an S&P 500 index fund in my 403B and in my 401k. I don't even have to babysit it. It's just there, it's regular. So now I can just focus on my actual trading account at my different brokerages. So here, I got a nice example here for you, a monetary example. You get paid $1,000 every 2 weeks. And let's say you decide to put 10% into investments every pay period of $100. So 10% of 1,000. And you put half of it, so $50, into an S&P 500 index fund, which is basically probably the best fund out there that's beaten most of the mutual funds out there. If you have any investment option at work, and you just look at S&P 500, they're bound to offer that as a choice. I can't think of any employer that has a 401k that won't offer that. So it will be offered because it's the most common one. It's the biggest. So let's say you do it over 10 pay periods. By putting that $50 over 10 pay periods, you took advantage of when the shares actually dropped, even though overall over the 10 pay periods, the shares climbed from $10 all the way up to $11.25. So over time, so like here, pay period 2, the shares are now $10.50 each. You're still putting $50 in, and you bought 4.76 shares. Price goes up again to $10.75. You bought 4.65 shares. By pay period 6, all right, it's dropped down to $9.95 a share, but that's okay. Now you bought 5.03 shares. So you're buying more when they're cheaper. You automatically will be forced to buy less when they're too expensive. So it's a great way to regulate your buying. Overall, over 10 pay periods, the average price you paid was $10.48. But by pay period 10, those shares are now worth $11.25. So you've paid a lot less per share over 10 pay periods doing this method. Over that 10 pay periods, you ended up buying 47.71 shares, and now out of pocket you paid $500, but the market value of what you paid is now $536.79. So you're already up almost 10% in just 10 pay periods. So what if instead you just decided, well, I'm just going to buy them all up in one lump sum. In week 4, say, all right, I'm just going to buy it at the end of the month or at the end of 4 weeks. But it happens to be one of the higher points in price during that market period. So all $500 all at once, $11 a share. So you bought 45.45 shares, and you have less shares, and you pay more for it per share. So one lump sum is good if you happen to catch it at the lowest price. But unless you have a time machine, there's no way to know when the lowest price is going to be, because you could have picked a low price, but then if the market keeps on trending lower, then when do you know when the bottom is? And it's even worse if you happen to pick the top. So dollar cost averaging kind of takes the guesswork out of it, which is kind of nice. But again, caveat, again, as long as nothing has fundamentally changed why you like the stock in the first place. If you don't like the stock anymore, management changed, their philosophy changed, their business unit changed, their revenues and profits have changed, or whatever they're making is suddenly illegal, whatever. A new competitor comes along with a product that's much better than the company bought, then you may have to let it go. But again, if the company's still good and you like it, dollar cost averaging is great. And I've used it for many years with companies like Pepsi, Microsoft, General Electric for a time before I got rid of it, AT&T before I got rid of that. So a good place to start, and I didn't put it on here, but I always mention it in all my classes. If you're thinking of companies that dollar cost averaging would be a good practice, you can Google dividend kings as a term, or dividend aristocrats as a term. And the distinction is dividend kings are companies that not only pay the dividend every year, but have increased the dividend every year for at least 50 years straight. So you see a lot of well-known names on that list. It's not a long list, but you got your Exxon, you got Johnson and Johnson, Lowe's, Coca-Cola. I mean, really familiar names on that list. And then a similar list is the Dividend Aristocrats list. So they've increased dividends for at least 25 years straight. So like, again, all the Dividend Kings plus like McDonald's, Home Depot, and Pepsi, for example. So very familiar names. It's like you're getting a raise every year. And over time, if you both dollar cost average and if you get a raise in a dividend each year, the average price you pay keeps on dropping. So I'll use myself as an example. I bought, when I was still in school, part-time at night, part-time job, when I was studying. I used my part-time job money and bought 10 shares of Microsoft. $150 a share at the time, but again, never let price be a deterrent to buying a good quality stock. I'd rather have 1 share of Microsoft than 100 shares of some penny stock that might lose you money in the long run. Shares, that's the one. And I'm using it again. Those 10 shares over time split multiple times, so it had doubled 10 shares to 20. And then 60, then Microsoft started paying a dividend, but I refused to, except for once, receive the dividends in cash. I always directed Microsoft's bank to please buy me more shares of Microsoft with this free money that you're giving. So, and then those shares are now over 240 something shares just from the 10. I haven't, my $1,500, I haven't spent a penny more than that in my Microsoft investment, but because it's dollar cost averaging and because the dividends have been reinvested, my average cost price per share of Microsoft is about $8 a share. Microsoft is now selling for 200 and, as of today, between $260 and $270 a share. So, yeah. So, and anyone can do this. It's a very powerful tool. The key is you got to start. There's an old Chinese proverb, best time to plant a tree was yesterday. Second best time to plant a tree is now. So if you haven't started, go ahead and start. And just from looking around the room, I don't think any of you is probably going to be retiring anytime soon. So you got some time to put some money away and let compounding grow. So the last topic we're gonna talk about today is NFTs, which was requested by actually one of the daytime attendees last week. So this one's the big handout, and I did some fun research on NFTs. First of all, let me bring this over here. Have we heard of NFTs before? Yeah, I know there's some hype on it. I haven't invested in, and it's not like it's kind of comical for some of what these are selling for. Some of them look like they were drawn by kindergartners that are selling for outrageous sums of money. So non-fungible tokens. Again, textbook definition, NFT is a non-interchangeable representative digital asset stored on a blockchain that cannot be copied. And this here is part of the attractiveness. It's like owning a one of a kind that we can't touch nor feel. Now, based on media, we have one notion of what an NFT is, and we think about it as artwork, collectibles. There's virtual trading cards now. A lot of celebrities have their own NFTs as well, but NFTs goes beyond the art collectible, actually, and that's what a lot of people don't know. So ERC20, again, standard for tokens on the Ethereum blockchain. Ethereum is my favorite type of crypto because one, it is just one of the two biggest besides Decrypto, which is Bitcoin, but Ethereum works as of September last year on a lot less expensive network now. when they went to a software change from a proof of work to a proof of stake, meaning instead of having to mine Ethereum, which consumed a lot of energy to do so, now it's proof of stake. You actually just have a stake of Ethereum. You just prove that you own coins of crypto, which is about 90% more energy efficient than Bitcoin is. So non-fungible, what the NF stands for, means that they're not interchangeable, that you're unique. Fungible means that the whole pile of them is all the same. If you got a pile of corn kernels, that's fungible. If I got a barrel full of rice, every single grain in there, it's all fungible. They're just totally interchangeable. So non-fungible is just the opposite. These are interchangeable pieces of digital assets. So it's just non-unique. Baseball cards, that's non-fungible. Other types of collectibles. Over spring break, I was going through bins of collectibles of various toys I have that I want to sell on eBay to raise money. Those are all non-fungible because they're unique. I have to, which is a pain in the ass, individually research what the prices are for each one of those. So token, the T in NFT. Token just denotes that this digital, very unique asset is stored on a blockchain. And since the blockchain is non-centralized, meaning that pieces of that network are on different servers, it basically makes it impossible to duplicate because you can't be able to touch all the servers on that blockchain to be able to duplicate that asset. It's spread out. Now, physical NFTs. So what's interesting is they'll link something in the real world to the digital NFT. So if you own the physical NFT, you also own the digital NFT. So there's some examples like concert tickets. So they're unique concert tickets to buy. Real estate deeds and physical artwork. So if you own the physical NFT, you will own the digital NFT equivalent if they have them. So this is where the token part comes in and makes sense. It's not duplicative. You actually have the unique rights to that particular artwork. So that's one NFT that you may have seen. So the physical and digital tied together. And then of course the ones when they first came out, and yeah, this is really recent technology, only less than 2 years old. The digital or the non-physical NFTs where it first came out, avatars for the metaverse, digital art, including all the weird ones that I've seen. Music is another one that's been produced in NFT form as well. This is a very good side-by-side graphic. So again, they both are run on the Ethereum network. So ERC20, this represents how it's on the Ethereum network for tokens. ERC20 may represent a lot of different entities that sell the NFTs. High trading volume, high trading liquidity, and again, that's something that you want to look for. And trading anything, actually, liquidity. So as a trader, that's the number one thing you look for is liquidity. Buying as a buyer or a seller. Because anything that has high liquidity, whether it's stocks, options, NFTs, meaning that there is an easier chance you're going to get a price for it, whether you're a buyer or seller. There's a closer spread between what buyers are willing to pay for it and what sellers sell enough of it. So high trading volume. Now, ERC 721 NFTs, low trading volume, not as liquid. There's a fixed supply of ERC20, so there's only a finite amount. ERC 721 NFTs, it's variable, so there could be more made. NFTs are not crypto. So even though they are on the blockchain, NFTs aren't crypto because they're non-fungible. They're non-interchangeable. So whereas you could buy and sell Ethereum and it's going to be the same Ethereum. Same with Bitcoin. NFTs, you can't buy and sell NFTs and they would be the same because of their uniqueness. The difference between coins and tokens. So this one's interesting. A crypto coin is native to a blockchain like Ether, which is part of the Ethereum network. Let's see. Something written down here. Well, basically what this says is, since it is on a particular standard, it makes it easy to buy and sell on that Ethereum network your NFTs. How can I buy and sell NFTs if you are actually interested in that? First thing, open up a crypto wallet so you actually have the crypto to pay for the NFT. Locate the blockchain where that particular artwork or collectible resides on. Then whatever the blockchain that it's on, you take your crypto out of your wallet and buy the crypto on the blockchain that the NFT is on, if it is different from Ethereum. Hopefully it is Ethereum. And then find the page where the NFT is and then buy it, open an account with the market, and then connect your wallet to the market where that NFT is located. So I've never done it, so I can't say that I have, but the flow chart seems pretty self-explanatory. I think for me, the inherent risks with wallets, and you have to just be careful who is the custodian of your wallet, because we've seen just in the past 6 months, we've seen SFX go down, one of the biggest crypto wallets out there. We've seen there was another one that went down just shortly after FX went down, and then there's fewer and fewer players left. I mean, Coinbase is still intact, but because there's such a danger either from embezzlement from the owners of that blockchain, like with Sam Bankman-Fried, or simply just hackers hacking into wallets. And there's more than enough stories out there of people having their wallets hacked into. So even before you actually get it out of your wallet to purchase the NFTs. So again, there's that inherent danger. If you want to sell an NFT, basically it's kind of in the reverse. You have the marketplace account, connect your crypto wallet to the marketplace, sell the NFT, and then choose the sales price and decide whether to accept the offers, set how long you want the sale to go on. You can also choose if you want to sell it to a specific buyer, which which is an option that I think they have on eBay now. Where can they even buy NFTs? Well, these are the sites so far, and again, sites can go up and down, disappear all the time, but at least as of this writing, OpenSea is one place that are centralized, and these are 2023 sites. So Ethereum, Arbitrum, Clayton, Optimism, Polygon, and Solana are supported network tokens. I've got Ethereum, I've got a little bit of Solana. Magic Eden, there's commissions that they charge. So 2.5% commission on OpenSea, 2% transactions on Magic Eden. They accept Solana and Ethereum. I think if you have Ethereum, you should have no problem with exchange. You just pay it with your native crypto. Rarible, that's a clever name actually for an NFT. They accept Ethereum, Polygon, Solana, Flow, and Tezos. I haven't heard of Flow and Tezos. Nifty Gateway, that's a fun name. They only accept Ethereum. I did find out that the fees are very expensive, apparently. Binance, which is actually a pretty well-known crypto wallet. So they actually accept Binance and Ethereum. Their fees seem to be the lowest, so 1% plus some other expenses. What are some of the top NFT collections to buy from? Other Deed, Mutant Ape Yacht Club. What a name of NFTs. I've heard of this one, Bored Ape Yacht Club. I guess Mutant Ape is trying to cash in on the title. CryptoPunks apparently has the biggest set. Azuki, Clonex, Meebits, and Moonbirds are some other ones that have the biggest market shares. It's apparently a bigger business than I realized. If the floor price or the minimum price of buying an NFT from CryptoPunks is at 66.29 Ether. So Ether right now, and this is an old price, I think last I looked, Ether is trading about $1,700 a coin, almost 1,800. So the cheapest piece of artwork you buy at CryptoPunk would probably be over $90,000, which blows my mind. It's like, I don't know why. There's so much I can do to make money faster than having to wait for some investor to buy that NFT from me. So here are top 5 NFT projects by market cap. So again, and it's mind-boggling how large market cap these firms, I guess they're firms, are. CryptoPunks, 906,000 Ethereum. Bored Ape Yacht Club, 794,000 Ethereum. It's amazing. Now, besides collectibles, NFTs do actually have practical uses in business. So in the real estate industry, they can allow for immutable storage of deeds, faster and more cost-efficient transaction, as well as actually fractional ownership of real estate. So a lot of the crowdsourced real estate sites like Fundrise, for example, where they allow fractional shares of real estate, which is actually a really cool concept. NFT technology can actually protect and make unique via NFTs fractional real estate. Music, they can actually sell digital tickets, receive immediate payment, and interact with their fan base through NFTs. NFTs can actually be used in medicine. So you can actually have medical records stored on a blockchain through NFTs. Since it's decentralized, it allows for greater security. And we've seen a lot of news lately about medical records being hacked on the native servers at the hospital by hackers, basically demanding ransom to be able to get access to the records again. So by actually storing them on decentralized, it makes it tougher for hackers to hack into medical record databases. And tickets. So selling tickets via NFTs makes it easy to transfer, also makes it easy to verify ownership. So there are actually practical uses besides the crazy artwork use of NFTs. Yeah. Yeah.
Is that an incentive as far as like if you set up a REIT or something, you can store the deed on that NFT, or is that specifically separate from the REIT and you're trading it?
It would actually be separate from a REIT. However, I think setting up ownership by setting up an NFT to show uniqueness is actually a pretty good idea. And it would not surprise me if that's another use for decentralized NFT technology to protect deed ownership, especially when I hear a lot of TV and radio ads where criminals are trying to steal deed ownership from people that way. So NFTs are a way to protect that. There are some other use cases besides from the ridiculous expensive digital artists. Oh, this is fun. Beeple, and I just had to add this, Beeple sold an NFT, which is a digital artist who actually jumped, lucky for him, on the bandwagon when NFTs first started becoming an existence. He sold a piece of art or NFT art for $69 million at Christie's, which is the premier auction house. So NFTs and real estate stored on immutable blockchain networks. So what goes into a blockchain can't be altered or tampered with. So Braden can see a value to that. Now there is an exception, so it's called the 51% attack. If a hacker has the ability to gain more than 50% of the network's coins, they can actually change the network. So I don't know how tough that would be, because since it's so decentralized, to be able to get into 51% of them It's, if the network is large enough, like Bitcoin and Ethereum, it's unlikely. But I know there's a lot of smaller networks out there, so I guess depending on the network that they choose to put the deed on. Let's see, immutable ledgers are revolutionizing the way the world buys and sells real estate. In third world countries, it's not uncommon for new regimes to seize property of residents. So if people's deeds were instead saved on a blockchain, it would be difficult for a dictatorship to take over people's real property, which I think is kind of creative. Yeah. Oh, yeah, that would be. That would be great. I'm actually more concerned about income taxes and property taxes. NFTs in the music industry, I think we talked about that. Distributing work, receiving immediate payment, publishing work, interacting with a fan base. Of course, with younger fan bases, they're all into new digital types of assets, including NFTs. NFTs and medical records. Other NFT use cases, NBA Top Shot. You can allow for buying and selling of digital moments in basketball history, which blows my mind. How could you buy a historical moment? So you could own a digital right to a Michael Jordan dunk. Isn't that crazy? It's like you could own a piece of history via NFT. I can't even wrap my mind around that. Yeah.
So what about if they use that NFT, that image in?
Well, that's actually I've seen cards like that, like athletes having their own NFT cards.
Oh, so they would own their own NFT.
Yeah. So and they would buy and sell it. I think a lot of the times you would have the physical card, and then there would be a digital NFT attached. So which gives you all the rights to the fund.
So if someone, in instance, went out and used that photo for something else, you could come after them for.
Technically, yeah, as the owner. Although I don't know if that's ever been in court,
Yeah.
because that's another thing that puzzled me about NFTs, because really, someone could own the digital NFT, but you could look at it on the internet, screenshot it, and you have a picture of the exact NFT that someone has. They own it, but I can look at it anytime I want. And yeah,
That's right. I was gonna ask you, like, might be a dumb question.
no.
Just how did the market for NFTs even arise? Like, how's value created?
This is what I talked about with investable assets versus commodities. So there's only certain assets that are considered real investable assets: stocks, bonds, real estate, even safety accounts, money market accounts, because they actually have an inherent value either in producing goods and services, or like in real estate, they can generate rental income, or bonds can generate interest income. Any commodity, gold, silver, collectibles, NFTs, even crypto, which according to the IRS back in 2014 is considered a speculative commodity. Their value is only derived by market of buyers and sellers. So unless you have buyers actually willing to pay a certain price for it, that's the only way it's derived, because they don't make any products or services. It's not a business. It doesn't even have an inherent value as a building material like gold is. It doesn't give you interest. It doesn't give you wealth. So again, its value is only derived from a buyer's price, and negotiating between buyers and sellers. So that's why it's considered a commodity and not by definition an investment. So
You can chalk like something like crypto up purely to being a gambling space. Not gambling, but like there's no intrinsic value to the token.
yeah, you are speculating and you're hoping that someone will keep on bidding the price up.
Yeah.
And that being said, Bitcoin is actually the highest return of any asset in 2023. It's about over 60 as of yesterday. But the thing is, it took that much just to get it to $27,000 in value. Beginning of last year, it was over 60,000. So it's not even close to where it had been. And it's like, can you stomach that drop? The drawdowns are bigger for speculative assets. I mean, I have crypto, but I consider it my lottery ticket. It's a fraction of all my investments. If it does great, great. If it doesn't, then it's not going to kill me. when it comes to retiring early type goals. The minting of it, I'll let you take a look at the flow chart. It is pretty interesting how NFTs are actually made on the blockchain. So there's a little description here. So here are the final thoughts. NFTs are digital assets. They're stored on the blockchain. They cannot be copied or divided. Of course, someone actually gets 51% of the network, and they could change it, but again, not likely. Physical NFTs represent real-world assets like art and real estate. Non-physical NFTs represent digital, such as digital arts and sports clips. All NFTs on the Ethereum network are created using the ERC 721 standard. Do NFTs work like cryptocurrencies? Well, they're not, but there are some similarities. They're both digital assets and they're both stored on the blockchain. What's the future of NFTs? Unknown. In early 2023, so again, this is pretty recent, sales plunged more than 90% from the year before. I think people are starting to realize what they really are. If broader crypto market begins to recover, there's a good chance NFTs could rise in price. Yeah, because there's a good correlation between the price of NFTs and the price of crypto. Are they a good investment? Well, there's different types. Determining if NFTs are a good investment will depend on your risk tolerance and your conviction upon the product. So my profession, I'd probably say no, not at this time. They're purely speculative. Actually, by definition, based on their characteristics, they are speculative. Last thing I want to remind you, if anyone, or including yourself, wants to be an officer, I have none right now. My officers graduated last fall, so we are on hunt for new officers. A lot of the work's been done by the previous officers. We have all our banners, and we don't have our own swag yet, but we can always ask for that next year. But our budget's very manageable. As a matter of fact, I have to present our club budget because we actually get school funds from student activities to manage the club. And our budget right now is just for food. So hopefully at future meetings, we'll have food. Here we have food, so hopefully this year we'll have food. But we only have 4 officer positions, president, vice president, which pretty much are the same. Basically the face of the club that shows at different events at the college or recruiting tables. Secretary, this helps send out the meeting notices and keeps track of the membership list. And the treasurer, which keeps track of it. Again, third Tuesday of every month is when we usually try to meet. Next month, actually I have a class Tuesday night, so I won't be able to do the night meeting, but they meeting here, we'll still go on. But my class, Tuesday night class will end at the end of April, so we'll be back to regular meetings in the day and the meeting here, and that's starting in May. Yeah.
And then you said before COVID, we were meeting
Weekly.
Yeah, that ever gonna happen again?
I wouldn't mind that, actually. The cool part about the weekly meetings, at least for the daytime meetings, is that we always pull up the market. I pull up my account, we do some trading, or the president will pull up our account, we take a look at some live trades. So that was always fun.
Yeah, I'd love to see that.
Yeah, oh yeah. Because we would, since we were both trading options, I pull up the option platform and I actually demonstrated how it works and how we always use math and statistics to decide on a trade. Never use emotion, never use speculation, always use the numbers because you can't fudge the numbers. Thanks for coming out. Yeah.
Good question. Do you think software has a role in that in terms of like this?
I'm trying to get into this trading platform.
Yeah, I'm trying to get into.
Well, at least speaking to my options trading platform, software has everything to do that because the more user friendly it is, and a lot of the mathematical legwork done for you, the easier it is to make the decision on the trade.
Right, like I downloaded this from Strat.
Okay. I will tell you the one that's a little more robust and probably easier to understand. Look at they're the best. Their customer service is crazy fast. Nights, weekends, usually get. They have their own food show every day. Right. I've actually I've had the talking heads. One of the talking heads on the show. Yeah, they do care. On last couple of years, number one customer service out of all of them. I'm talking about like Fidelity. Yeah, they want us. And the CEO, I'm going to full time at the conferences. Captain Jeans, just like everybody else, but
Right.
he's passionate about teaching the little guy how to build wealth, and that's what's really awesome. I learned so much from him. Sure.
So, I don't know.
My brain, I know exactly to get you started.
Okay, yeah, I would like to get started, for the new year.
Yes, yeah, $5 a week, it doesn't take much to start. I think $5 is at least the minimum for most of the online brokerage firms. But again, get started and you can easily. Mhm. Oh, yeah. So, there are brokerage firms that charge zero fees. The old ones, the ones that don't charge anything. There's even myself. Theirs is really robust. I use it mainly for option trading, but for buying stocks, there's a couple. I have both Webull and Robinhood, both zero commissions. Webull have a lot of great tools, very fast, and if they allow for partial stock investing, meaning you can buy fractional shares, it doesn't matter if the company stock is expensive. Say like, Amazon, 90 something bucks a share. Maybe expensive, but you could buy $5 worth of it. You could buy a piece of it and buy pieces. Ultimately, those pieces become whole shares and you can let them grow. My own self. Beginning of each month, well, beginning of this one. Every month. So right now, I'm actually getting whole shares because both of those shares are about 100 shares. I'm getting close to one share every month. So I'm just building and building. And since we're in a bear market right now, this is the best kind of our quality company because 3 years. The last bear market was the fastest since 2020. And also, bear market before that was 2. But then there was a 10-year bull market after that. Bear markets, and that's one all the way back to 1920s, have always been, markets have always been shorter than bull. And everything so after every bear market was always been bull. Right now, it's just acquire the shares when they're cheap, just wait for them. As long as companies are falling. There's two, again, that I've done, so Robinhood and Webull, if you want to buy shares. Tasty Works is also great to buy shares, they got a great app. Yeah, oh, yeah, it is even on the phone. I do my trading on desktop, it's I need a big screen. But if I'm just buying some stock, right. Press, yeah, transfer the money from my checking account, press a button, then press the button on the chair, I'm good. So I don't have to watch it. My trade, I do have to watch, so I'll pull up on the laptop.
I can use my account.
Oh, sure.
Restriction. And it's asking me about forward paid securities limit. So.
Oh, okay. So what that means is, you can cash account, meaning that whatever cash you deposit is going to be able to back up the trade. If the trade goes wrong, you have to cash it.
Oh, okay.
So, what they also do, in addition to that, if you are deciding to trade in any derivatives on options, then having cash on hand will be able to back up Like, for example, if you do a trade that costs 500, less whatever cash you get in the trade, I'll give you an example. Let's say if I wanted to do, I wanted to do an options trade in Walmart. And it would cost me $300 for the trade, but if I collected, say, $150 in premium on the option, that means I would need an additional 150 to be able to cover the trade. Right. So some of it was from if the trade goes south, then I lose the 150. So the leverage, let's put that out. If the trade wins, then not only do I get the 150 back, I also get to keep whatever portion of the 150 trade works out. So that's what it is. So basically, like, you're actually using some of their money, some of your money that you're doing. If it's just a stock purchase, then it's just all your money, and then you won't use any of the brokerage money back.
Right.
That's all.
Okay, so I should probably agree.
Yeah.
I wanna. I've already texted.
No, you're fine. Especially if you're fine, then it's just, if you have that cash in the account, cover it and fine. What's interesting about fixing trades, they'll give you trading credit over and above. So if you purchase stock, it'll look like you bought it at a deep discount, when in reality, they're giving you additional trade credit. So there will, like when you pull up the Google account, you'll see buying power. Even though cash in there will give you actually have additional buying power. You want to buy stock and sell. That you can get in trouble in case something's wrong. But that's really what it is. So just keep in mind that if you're using it to buy stock, just buying enough so that whatever cash you have left will cover in case you need to sell it.
So
In
yeah,
other words, just invest more.
right, don't,
Don't
borrow
overextend
money.
money. Yes. Yeah,
Okay.
you should never borrow money to trade unless you know.
So you never trade on margin.
I do trade on margin.
Okay.
But what I do is I do what's called a multi-leg strategy, meaning that I cap what my losses are. So I know I don't have